Welcome, everyone. My guest today is Daren Blomquist, Vice President of Market Economics at Auction.com, to talk about housing market trends, including the rise in distressed property auctions in the second quarter. Daren, welcome back to the podcast.
Thanks. Good to be here, Sarah.
Great to have you as always. I always look forward to these because I feel like there is so much insight that you guys get at Auction where you can really see into a part of our industry and what's happening in a way that other data doesn't really tell us. So super excited to jump in.
Yeah, thanks for that. And I love our data as well. So I'm glad that I have a mutual appreciation. You have a mutual appreciation for it.
Absolutely. Well, let's get started with sort of the broad outline is like the number of distressed property auctions has been rising, right? So maybe you could walk us through the increase and what it means for the housing market from your perspective.
Yeah, absolutely. In the second quarter of 2025, which is our latest data, we saw actually our foreclosure auctions as well as our bank-owned or REO auction volume. Those both increased about 20% from a year ago. And both of those are now at about a 2-year high. And so that stood out to us. And that was, it was pretty broad based across pretty much every loan type, not just FHA, VA loans, although VA loans spiked a lot. And we can talk about that if you want to, but kind of for some different reasons. But it was pretty broad across all loan types. And then it was also pretty broad based across most markets, many markets across the country. And although it was definitely, we saw some bigger increases in places like the Southeast and the Sun Belt. So places like Phoenix, Houston, Dallas, Atlanta, all saw some pretty big increases above the national average. And so what that's telling me is that there is this softness that we're seeing in the retail market is also rippling out to the distress market and kind of vice versa. It kind of acts as a vicious cycle, unfortunately, where some of the weakness in the retail market means that homeowners who are facing foreclosure or facing delinquency may not have as much equity or as many options as they did before to avoid foreclosure. And so they're moving into foreclosure and actually going to the foreclosure auctions. And then as we see more volume there, unfortunately, that's going to put more pressure on the retail market as well, and potentially put more pressure on home prices, which then you have that vicious cycle. Now, I don't want to overstate things, but I think, and one way to not overstate things is to point out, even with this 2-year high in foreclosure auction volume, we are still about 50% of pre-pandemic levels of 2019 levels. At the foreclosure auction stage. And then if you look at those REO or bank-owned auctions, we are at about 1/3 of the pre-pandemic level.
I appreciate that context. I was just going to ask you, like 20% sounds like a lot. And is that a lot, or was it just that we were coming off such a low level?
Yeah, it's really more of the latter. We're coming off of such a low level. So we're seeing some of those big increases, but we're still well below that 2019 level, which even at the time was not this overwhelming high level of foreclosure activity. So I do want to definitely put this in context that this is not the beginning of another 2008 or anything to that extent.
So I am surprised to see it so widespread. Like normally we can kind of say, oh, we're seeing it in this area. Or these kind of localities, but to see it kind of widespread and also across different loan types, I think is unusual. Yes.
Yeah, I mean, I think the common conventional wisdom over the last few years has been, well, the FHA and VA loans are the most susceptible and the most at risk for foreclosure, and for good reason. And we're seeing bigger increases in those loan types, but we're also seeing increases in conventional loans. And so I think that's what that's telling us is that this is not just about the slightly riskier loan type that we're seeing with FHA, but it's also about some of the market conditions that we're seeing that's putting more pressure on consumers. And, we were seeing this trend in other types of consumer debt over the last few years develop. And it's finally, I think what we're seeing now is this finally rippling out to mortgage, which mortgage was somewhat insulated because homeowners had so much equity. But the increases that we saw in, for instance, credit card delinquencies and auto loan delinquencies that trend has been happening now for the last couple of years. We're seeing that now more obviously happening in the mortgage delinquencies.
So let's dig into what you said about VA loans and what you think some of the particulars there are.
Absolutely. I mean, and I almost hesitate to say this number because I don't want it to be misconstrued, but we saw the VA completed foreclosure auctions go up by 428% year over year. And, whereas you had that 20% increase across the board. And the reason for the VA loan increase is because there was a foreclosure moratorium on VA loans in 2024. So basically you had next to no completed foreclosure auctions for VA loans in 2024. So we're coming off that extremely low level. And that moratorium was lifted at the end of 2024. So now some of those properties that would have gone to foreclosure auction in 2024 have just been pulled back and pushed into 2025. So that's the big reason. But we are still, you're still seeing increases, like I said, across the board, FHA loans, but it's more like high single digits to low double digits where we're seeing increases in those other loan types. I should mention the only loan type where we did not see an increase was USDA loans. Those are actually down on a year-over-year basis.
Do you have any explanation for that?
Actually, I don't. In terms of the USDA loans, I think, we haven't dug into that. And it is a pretty small percentage, as you might imagine, of the overall volume. The biggest pieces of the volume are GSE loans, which account for about 33% of the foreclosure auction volume that we have, and FHA, which is about 30% of that volume.
Well, let's talk about prices, right? Because this is something that we can really see trends in. The distressed property auctions have seen prices lowering. So what do you make of that, and what does that mean for the broader housing market?
Yeah, absolutely. So, I think this is an extension of the fact that we're seeing the volume increase and the retail market, softening. When I say softening, I'm talking about the increases in inventory and the pressures that's putting on home prices and home price appreciation, at least in some markets. And so what we're seeing with pricing at foreclosure auction is that our buyers who are purchasing at foreclosure auction are building a bigger margin and wanting a bigger discount. So a year ago, they were willing to pay 60 cents on the dollar at the foreclosure auction, which is a great discount, but so that's basically a 40% discount. And just to contextualize that a bit, that is off of the after repair value of the home. So a lot of these homes are in pretty bad shape, in pretty distressed shape. And so you're getting a 40% discount off of that home if it were in fully repaired, renovated condition. So just to clarify on that, because we always get questions about that, but so they're willing to pay 60 cents on the dollar a year ago. Now they're willing to pay 57 cents on the dollar. So they're building in a 3 cent bigger discount. And that may not sound like much, but that is an indication to us that these buyers are not confident in the retail market where they're buying, that those retail markets are going to recover anytime soon. And they're continuing to see weakness in their local markets, which is why they're building in those bigger margins for when they're buying at distressed auction. And so that's, to me, that points to continued weakness in the retail market, because most of these buyers, we call them local community developers. They're very aware, hyper aware of their markets. They know their markets like the back of their hands. And so usually they're right. Usually if they think the market's going to be weak over the next 3 to 6 months, the market is going to be weak. And this pricing component is signaling that those, at least in many markets that that our buyers think that their local markets are going to continue to have weakness, probably through the most of the rest of 2025. And I should mention that we saw this phenomenon of lower pricing at auctions in 57 out of 80 metro areas, so it is pretty widespread as well. Some of the biggest decreases were, again, in the Southeast and Sun Belt, so San Antonio, Riverside, California, Miami. Now, a couple exceptions: Detroit and Indianapolis also saw pretty big decreases, and then Houston and Atlanta. So it was pretty widespread, but the bigger decreases that we saw tended to be in some of the markets that are seeing big increases in retail inventory. And so our buyers are a little bit more cautious in those markets.
I think your point about those local market developers is so important. They're also the people it's usually they're putting their own money up. So like they're very good at what they do. Otherwise they wouldn't be in business, right? Like they have to know those local markets so well, or else they're not going to be in business long. So I think that's really interesting.
Yeah. I mean, I think just to hit home on that point, because I love that you said that, is that in order to be their success hinges on them accurately anticipating market conditions in the future. And they're putting down, usually at these foreclosure auctions or bank-owned auctions, they're putting down cash. It's not even their own cash. And so they have to be good at what they do, or else they will not continue to do it.
Great points. Well, let's talk about, so I thought this was really interesting. The market's also seen an increase in the number of vacant property auctions. What does that mean? And tell me why you have a vacant property auction instead of why is it classified that way? What does that mean?
Yeah. We thought this was really interesting for a few reasons, but we saw specifically vacant properties that are bank owned. So those are the REOs, or real estate owned properties. Those increased by 31% year over year to a 5-year high. So overall, we were up 20% to a 2-year high. Those vacant auctions were up 31% to a 5-year high. So really going back to almost pre-pandemic levels. And I actually think this is really good news on a couple of fronts, because you're basically clearing out inventory of unused housing inventory. These are properties where it's been foreclosed on. The bank now owns it. A lot of times the homeowner will stay in the property for a while, but these are instances where the former homeowner has left. The property is sitting there vacant. A lot of times it's falling into disrepair. There's deferred maintenance. It's a little bit of a blight on the local neighborhood. It's dragging down local surrounding home values. And so this increase in these vacant auctions is actually a sign to me that we're clearing out some of that unused inventory, and that inventory is going to get converted into supply for the housing market, and often affordable housing supply, because these are properties. 40% of our properties that go through auction.com are in areas classified as underserved neighborhoods, so either low income or minority in neighborhoods. And so we're providing more supply in these neighborhoods. And so that's a really good sign for me, number one. Number two is that we see with the vacant properties, it's more likely that we actually see an owner-occupant buyer as opposed to an investor who actually buys off of auction.com, because when the property is vacant, they don't have to deal with eviction, which is kind of a big deal, a possible eviction, or at least dealing with the current occupant of the property. And so those are more appealing to the owner-occupant buyers. And so that would mean, in fact, we saw so far this year, 20% of our REO auctions, those bank-owned auctions, are going to owner-occupant buyers. And that's up from 19% last year. And back in 2017, only 5% of those REO auctions were going to owner-occupant buyers. So I think good news on a couple fronts. And I can talk about this longer if you want, but I think there's a lot of evidence that this is actually going to be good, providing affordable housing supply for the housing market. And it pushes back on this. I think it also pushes back on the narrative that these investors are coming in there and just snatching up all these properties and somehow taking that away from the market. These investors are actually putting these these properties back into circulation in the housing market?
This is such a perennial question we get, or comment that I get, because I do the podcast all the time. Is people will be like, "There's all these vacant homes out there. There's just like millions of vacant homes, and we just need to free them up for, people who want to buy them." And it's hard to know what that means. Some of the vacant homes in this country are because they're just like they're falling into. I mean, you'd have to start over, or they're in places where there's very little opportunity. You could buy that house, yes, for what kind of job are you going to get out there? There's no services, whatever. So I think it's really interesting that you're seeing vacant houses, selling, and like you said, what that actually means for that community, what it means for supply. I love that.
Yeah, I mean, one of the unintended consequences of there was a lot of government help to help people avoid foreclosure during the pandemic, which was good to avert some kind of catastrophe. But one of the unintended consequences of that is that you did have these properties sitting in foreclosure longer and more potential to become vacant. Now, I'm not proposing here that we're talking about millions of properties by any means, but we're talking about thousands of properties per quarter that are potentially in this situation. And one of the data points I looked at is the average time these properties have been bank owned when they are sold at auction. And so far this year, those properties have been in bank owned for about 345 days, which sounds like a long time, but that is way down. Back in 2021, the vacant properties that were being brought to auction had been bank owned for an average of 1,500 days. So you have these properties sitting around vacant for a long time, and now we're at least working through those. And so the average time is down quite a bit to 345 days.
When I joined HousingWire in 2013, so much of our coverage was about REO, right? Bank-owned properties, and how are you going to maintain them, and how are you going to all the property preservation companies, because it was years and years of those had been sitting there, and so I had no idea it had gotten as long as that, even in before the pandemic.
Yeah. I mean, part of that number spiked during the pandemic just because there was a foreclosure moratorium. So there wasn't new inventory coming through. But still, I think there was this just unfortunately an unintended consequence of that moratorium and the foreclosure prevention efforts that caused some of these properties to be sitting around a lot longer. And now I think we're getting more of those back into circulation, which is a good thing.
It is a good thing. Okay, well, I wanted to ask you about the so-called Big Beautiful Bill, right? That passed because it had a portion dedicated to changing opportunity zones, and would love to ask you, from your perspective and what you guys look at, how are the opportunity zones changing? What does that mean for the overall market?
Yeah, I love this because I feel like it's an opportunity to tell the story of what our buyers are doing in the communities. And they're providing a blueprint for how the opportunity zones can help communities, help revitalize communities. And I think, I'm not commenting on the whole Big Beautiful Bill, but the portion that has to do with these opportunity zones is very good, because it's targeting, closing some of the, I guess, for lack of a better word, loopholes in the original opportunity zones that made it so not all the opportunity zones were really underserved areas. And so it's really focusing in on these areas. These neighborhoods have to be truly underserved, low income. They can't just be next to low income areas. They need to be in low income areas. And it's also requiring that 1/3 of all the opportunity zones in each state are in rural areas. And I think that's really a good idea, because we see a lot of the properties we've actually seen a pretty big increase in properties that are going to foreclosure auction in rural areas. And so there is more distress. Tends to be more distress in these rural areas. And so focusing there, I think, will help revitalize these rural areas as well. What we see is so when we look at the auction.com buyers over the since 2018, when the original opportunity zones were put into place, auction.com buyers have actually purchased 80,000 properties in underserved neighborhoods as defined by the FHFA. And 36% of those are in rural areas. And so I think our buyers are already on this train, and the opportunity zones will only help bring more investment to some of these underserved areas and really improve. And we do see that these markets are actually helped when you have an investor coming in, buying distressed properties, renovating them, and turning them over to homeowners. That helps not just that individual property, but the surrounding neighborhood and home values, and even provides jobs in that area. And so I think this is going to be a good thing to revitalize some of these communities. I talked to one of our buyers recently, Lindsay Davis in Birmingham, who's already been doing this. And I just love what she had to say. Because they've been buying homes in Birmingham, and most of them are, 49%. I looked at her purchases. 49% of the homes her company bought in Birmingham are in these underserved neighborhoods, and 39% of those that in those underserved areas are in rural areas. So she's already doing this, and she's already making a difference. And so I think the opportunity zone will attract more investors like Lindsay. What she said is renovated homes lead to increased property values, extended tax bases, and higher rates of occupancy. Each renovation project supports dozens of local jobs from contractors to suppliers, along with encouraging further private investment in areas that have long been overlooked. This kind of grassroots development proves that opportunity zones expansion can be a powerful tool for neighborhood revitalization. I love that. I wanted to mention this, Sarah, because I know we both have a Wichita connection, and we see, I talked to one of our buyers in Wichita, Kansas, and who's doing this. And he said, you're resurrecting things a lot of times, assets that are just dead. And he's doing that in Wichita, which I love, which is because it's my hometown. But that's the kind of thing that gets me excited, that there's some policy that's actually going to encourage what we already see some of these local investors doing.
I also think I follow a ton of developers on social, and what you see a lot of times with their strategy is like they are buying within a certain block radius of their other properties because they know the area, but also they're improving the area of what they have. And so if you think about the difference that buying and rehabbing a home, two homes within a 2-block area that were vacant or were, needed to be revitalized, you've just raised the property values of that whole area, right? That's what they're trying to do because that's good for their business, but it's good for everybody who lives in that neighborhood.
Yep. Yeah. I love, this phrase might be overused, but I really think these buyers are a good example of doing well by doing good. To keep going, they have to be making a profit and making money, but in the process, they're actually lifting all the boats in their neighborhoods.
We published a story, it was by Logan last week, and it said, why we should be cheering the mom and pop investors. And it's sort of like what you're talking about here, because it's like, so much of the conversation is like, oh, the investors are coming in and, Wall Street, and they're buying all the homes, they're pricing people out. And, we know that that's the majority of, home investment of these kind of things are mom and pop investors.
Yeah, that's right. And, and there's certainly bad players out there, but I think the vast majority are the good players. And we kind of self-selected on the auction.com platform because foreclosure volume is not like it was back in 2013, where it was just overwhelming the market. That's when you saw some of the big Blackstones of the world come in and say, oh, there's enough volume at foreclosure auction that we might want to buy. But there's not enough volume, actually, to be honest, there for them to be interested to buy at foreclosure auction. And so it is the vast majority of our buyers are these smaller local investors, mom and pop investors.
What do you, just to finish this out, what are you looking for the rest of 2025? What are some things that you're watching as you look at your data?
Yeah, I think, what we're seeing here with the increase in foreclosure auctions, I don't want, people might take that and become alarmed with it. I think what it is kind of a reversion to the mean. I mean, we're seeing the market normalize, and part of that is normalized foreclosure volume, which we're 50% below 2019 levels, which I would consider 2019 the closest to normal that we've seen in quite some time. So we're seeing a reversion to the mean. Right now, there's not an indication that we're going to see a big wave of distress hit unless there's some additional shock to the system that would, to the economy or to the housing market that would cause that. But right now, it's more of this reversion in the mean, which results in a rising tide of foreclosure auctions, but certainly not a massive tsunami or wave of foreclosures that are coming down the pike.
And to your point, I mean, this is a sign in some ways of a healthy housing market because it means we're getting those vacant properties out. There's more selection for people, just returning more to more normal. So that's really interesting.
I think there's a lot of things that were good that came out of the response to the pandemic crisis, which you now have a lot of things in place to protect homeowners who are facing foreclosure that were not in place before the pandemic. And those are still in place. And that, I think, we're giving homeowners who are in trouble every opportunity to avoid foreclosure as well. But you have that combined with it. There's a certain point where it may be in their best interest to walk away from that home. And when I say walk away, I mean actually sell it proactively prior to foreclosure. And that's one of the things you didn't ask about, but I'll throw it in there as a shameless plug that we're now allowing individual homeowners on our platform to, not just banks, to post their properties for sale, which we think will help those distressed homeowners as well.
This is so interesting, especially in the light of the bigger, what we call portal wars, about where people are able, like just in, on the retail side, where people are able to post their listings, the different companies and how they're deciding to hold those back or not. Anyway, very interesting that you guys are doing that.
Yeah, and, just a small part of that, but yeah, we want to enable especially distressed homeowners who a lot of times they're in a situation where they don't want to, or it's very hard for them to do showings of the property. And they also may be in situations where they want to lease back the property for a while, for instance, after the purchase. And our buyers are very accustomed to those types of situations. And so our buyers are used to dealing with those kind of out of the box type of purchase situations.
Amazing transparency to just help the market. So Daren, thank you so much for being on. I always learn a ton and I think it's just super interesting. So thank you.
Thanks, Sarah. Appreciate it.